Namaskar, hello and welcome friends to Finavision, your one-stop solution for CFA exams. My name is Shushmit Aditya Mukherjee. I'm an educator and an investment research analyst, and this video is a short excerpt from the full class series for CFA Level 3 curriculum. Hope you enjoyed this video. Let's get started.
Econometric modeling. What do we mean by econometric modeling, friends? So in the last example, what we saw is there is a 100 years of trend growth rate that is happening, right? There is 100 years of trend growth rate. Now, if you zoom in into any sections, which we did, there is a waviness to that trend, right? It was something wavy like this, right? Now, to predict the waviness in the trend is basically to predict the business cycle that is part of that trend growth rate. The trend growth rate can be very, very long term, but the business cycle is much shorter in term. It can be 5 years or 10 years or 15 years or whatever. Now, predicting these cycles is a very important part of investment analysis and investment decision making, because the better you predict these phases, the better your returns are, because the better decisions you are able to make. So here, econometric modeling means basically trying to devise ways of predicting what phase this business cycle is in currently and what phase is it going towards, and the timelines of the same. So here there are three kinds of ways in which we try to predict the phase or predict the way in which the business cycle is going towards, right? Let me remove the rough work. These three ways are econometric models. Let me circle it here or highlight it here. Econometric models is one way. Then there is a way of indicators, creating indicators or finding out indicators. Then there is checklist way, which is basically a subjective way incorporating questions and answers of different kinds. Now first, to discuss the econometric models. Econometric models are basically a bunch of equations or rules that are mathematical in nature, and applying them you try to predict where the market is heading towards or where the business cycle is heading towards. Now, econometric models can be of two kinds. One is the structural models and one is data driven models with heuristic rationale. What is data driven model with heuristic rationale? Basically, you are not trying to devise any mathematical equation which is very, very rigid or robust, but you are trying to do some empirical analysis based on data and based on certain judgments that you have, based on data that is available to you, and the rationale that you apply is mostly heuristic. There is no fixed equation or mathematical principle behind it. It is a data-driven approach with minimal application of equation or mathematical theories. On the other side of the spectrum, there is the structural models. Structural models are deeply mathematical and theoretical in nature, and they can comprise of hundreds of equations, hundreds of models, hundreds of structures, and together they form this predictive analytical model. This is based on theory, based on mathematics and all that. And if you try to reduce the impact of theory and mathematics just a little bit, make it lighter, a little lighter, then what forms is what we call reduced form models. So structured form models is the most theoretical or most rigid and robust kind of way of defining the cycles. And if you reduce the theoretical impact or the mathematical impact slightly, then it becomes reduced form models. And if you reduce it further and make it completely data driven and empirical, then it becomes a data driven model, heuristic model, right? These are the three main ways you can do it. Then comes the way of indicators. Now if there is a business cycle, the indicators can be of three kinds. First is the leading indicators. Leading indicators means these indicators predict the cycle before they happen. They predict the cycle before they happen. Then there are coincidental indicators, or indicators which coincide with the phase of the cycle. Then there are lagging indicators, indicators which confirm that certain phase of the cycle has started already, right? Now, the most emphasis is on the leading indicators. So indicator driven approach is mainly leading indicator driven approach. Then comes the checklist way of doing things. This is basically you have a flexible way of judging where the market is heading by creating question and answers of different kinds. You can use any kind of indicator, any kind of variable, any kind of aspect you can try to explore and fit it in the checklist model. So now all these models have their own advantages and their disadvantages, their own strengths and their own weaknesses. Now one by one we will try to understand what are the strengths and weaknesses of the econometric models, of the indicator models and the checklist models. So let's start. First we'll talk about the strengths and weaknesses of econometric models. Strengths and weaknesses of econometric models. So strengths are, it is very robust. That is, the equations might be defined, the theoretical basis might be defined, the variables, the parameters, everything might be defined. And this gives it a very robust nature. Robust means the platform, or it is very stable in nature. Then the next point is multiple factors can be incorporated in that model. So there can be hundreds of equations, which means huge number of variables can be incorporated with respective parameters. Then another advantage is quickly generates output. If you just put in the inputs in the variables, the output is generated. No matter how huge the number of variables are and how big the number of equations are, once the model is created, you just need to put in the inputs and the output is there for you, right? Quantifies impact of exogenous shocks. Because it is a very complex model, it can encompass the impact of exogenous shocks also. So it can actually quantify what is the impact of a certain kind of change in the policies, in the geopolitics, in the way technology is occurring, in the way the financial system is going, right? So all these things they can incorporate and quantify what is the impact, how much is the impact of these kind of changes or shocks. The next advantage is it imposes discipline on the analysis process. So once you have the theory, once you have the mathematics, you are very particular which way you are going and you need discipline to stick to that. You cannot, this kind of model makes it very difficult to diverge from the basic premise of creating the model. So it imposes discipline on the analysis process or on the analyst itself. Now comes the weaknesses. With the advantages come certain weaknesses also. For example, the models are complicated and take a lot of time to build. Obviously, if you are creating hundreds of equations and numerous variables are there in the model and you are trying to specify what kind of model fits in, is it a linear model, polynomial model, logarithmic model, what kind of model is going to fit in, for example, then it takes a lot of time. So model is complicated and it takes a lot of time. Then data inputs are not easy to forecast. So data inputs are not easy to forecast. Obviously, in the model, all levels of the economics are there. The geopolitical levels are there, the financial levels, the currency levels, the behavioral levels, everything might be there. And predicting all those aspects simultaneously and correctly might be very, very difficult. So that is another difficulty or weakness of this model. Relationships are not static. So the equations that you create may not be parametrically or variable wise consistent all the time, right? The equation may change over time based on policy changes, based on structural changes, etc., based on behavioral changes, etc., etc. So relationships are not static, but your model once created becomes static, and that is another difficulty or another weakness that you face when you are using structural models or econometric models, right? False sense of precision. After you create a precise, very robust theory and very stable theory and stable set of equations, there is a sense of precision which might be false. Empirically speaking, the real world incidents may diverge, right? Econometric models often are not good at predicting the turning points. That is, the market is in a recovery phase and it is going to go into expansion mode soon. This kind of prediction is very difficult to make when you are using an econometric model. Or the market has peaked and it's going to go into contraction soon. This kind of prediction is also very difficult when you are using econometric models. Trending phases are easier to handle when you are using this kind of a econometric model or a structural model. Strengths and weaknesses of leading indicator based approach. Leading indicator based approach. So we say that indicator based approach is basically leading indicator based approach, right? So here the strengths are intuitive and simple to construct, usually speaking. Then focuses on turning points primarily. See, in the previous case we had a disadvantage or a weakness where the turning points were difficult to predict. Here with the leading indicators, turning points become much more easier or much more efficient in predicting. Then easy to track. The data that you require for all these leading indicators can be received from a third party, and that makes it easy to track the data. But with the advantages comes a few weaknesses also. So, number one weakness is prone to frequent revisions. Let's say you are looking at previous quarters or previous to previous quarters GDP numbers. Chances are they have been revised multiple times. If you are looking at 10 years of quarterly GDPs, chances are many of them have been revised many times. Now this makes it very inconsistent or unreliable for model creation. Then overfitted. Now once you create a sample of leading indicator data, that is let's say 10 years of leading indicator data you have with yourself, and you try to predict something, let's say the price of stock index with it. Now you create a model out of it. The thing is, the sample is overfitted because you are using a particular sample there. The future may not match with the past. The future may be different than the past. And therefore, when you try to apply this overfitted model into the future, that is in the real world scenarios, it may not exactly match, it may diverge. So overfitted model and divergence is possible from the real world situations. Can give false signals. Indicators can give false signals. Let's say the theory says that yield curve inversion predicts a market correction. Now this is a leading indicator you are trying to use, which may not always apply. It may give false signals also. You may predict that the market is going to correct and reposition your investments, but ultimately find that the markets have not corrected because there are so many factors which have not been accounted for in this analysis. So this can also happen. Not much more than directional guidance. This is the fourth disadvantage. So they can say there is a turning point upwards or a turning point downwards very well, more often than not. But quantifying it or putting a time horizon in it, these indicators are not so good at that. So this is another weakness. Then comes strengths and weaknesses of checklist approach. Checklist approach. So we'll talk about this checklist approach, which is basically a subjective approach. It is created through a set of questions and answers which can incorporate anything from any aspect, from any dimension. Behavioral, economic, fundamental, technical, anything. Geopolitical. Now, let us look at the strengths of this. Limited complexity. Obviously, you are looking at a lot of factors, but you are not looking at creating equations out of them or trying to create structural models out of them, right? You're just trying to create questions and answers to create a judgment for yourself. What is going to happen, how much of it is going to happen, what is the intensity, etc. etc. So here the complexity is limited compared to econometric model, right? Then flexible. Obviously any aspect can be incorporated in the model. In the checklist model, any aspect can be incorporated. It can be behavioral, it can apply alternative methods which are non-technical and non-fundamental, and that's why it is very flexible in nature. Breadth is broad. Obviously huge flexibility, huge breadth, any topic you can incorporate in the model. But with them comes a few weaknesses too. First is subjective. Subjective means it is arbitrary. Arbitrary means your own judgment is required. The analyst's own judgment is very important here. Then time consuming. Obviously a plethora of factors have to be reckoned with, which makes it time consuming. Manual process. We are not using automated systems which creates outputs from equations. We are trying to analyze manually. This has limits to the depth that can be applied, right? Thousands of variables may not be incorporated in it. There is a limit to the manual process. Then, bias and inconsistencies. Obviously, with subjectivity, with manual process, biases and inconsistencies may creep in. Because the breadth is so much, inconsistencies can creep in. So these are the weaknesses of checklist approach. Now friends, leading indicators, we have already understood their strengths and weaknesses. Sometimes leading indicators are used in a composite form. That is, a lot of indicators bunched together to give a certain indication upwards or downwards. These are called composites. And these composites, one kind of it is called the diffusion index. This is basically a combination of multiple leading indicators, leading economic indicators to indicate where the market is heading towards. So this is a combination of leading economic indicators. combination of leading economic indicators or LEIs. Now, one thing we have already understood is they have certain disadvantages like false signaling and frequent revisions of basic data, right? Now, to avoid this or to minimize this, there is something called nowcasting. Nowcasting is basically, let me give you an example, there is something called GDP Now, which tries to predict the GDP of the current quarter, this quarter, based on the data that is coming through to the Federal Reserve. This is called GDP Now and it is based on current data. This quarter's data you are trying to use to predict the GDP of this quarter itself. An advantage of this nowcasting is the data is not prone to revisions that much, right? But there are disadvantages also. Disadvantage like these are not predictive beyond a quarter. Beyond the quarter, there is no predictability of these kind of processes. Then there is the second point where it is very volatile to begin with. From the beginning of the quarter, this data is being reflected, but it is very volatile to begin with. And by the time it stabilizes, a lot of the information and a lot of time has already passed. So the predictive advantage of this is highly lost. So volatile for the initial part of the quarter and delayed stability, which takes away a lot of predictive advantage of this process. But one thing is, this data is not prone to revisions that much.
The link to the full class video is given in the description below. Please check that out. Thank you so much friends for being with me till the end of this video. If you enjoyed this video, please like the video and subscribe to the channel for more such classes. Share your feedback in the comment section below and share this video with a friend who may find this helpful. For enrollment to practical application courses, internships and CFA curriculum classes, check the description below. Till then, keep watching Finnovision. See you in the next class.